Welcome back to the Am I Rich Yet podcast, a weekly podcast for Millennials and Gen Zs where we help you save, spend, and grow your money smarter. Welcome to episode number 19, where we are going to be discussing tax strategies. I don't think I can say that with any more enthusiasm. Tax strategies! My name is Georgia. I'm one of your co-hosts. I'm a Gen Z current MBA student and navigating my personal finance.
Shoot me in the head, right? Tax strategy. Do you like paying tax?
No.
You better listen up.
Okay, and who are you?
I am Rob. I am George's dad, a recently retired financial advisor, and my job is to help you reduce your taxes.
Welcome to Am I Rich Yet? As always, we'll kick off with our questions for each other. Dad, do you want to go first?
I do. I have a question for you. You have a choice. Would you rather be able to watch a snowstorm or a thunderstorm?
Oh, I know where this question originated from because there's been a thunderstorm around us for a couple episodes we've been filming. It was a thunderstorm or a snowstorm?
Correct.
I'd say snowstorm because it gives me the mindset, like, immediately when I think of a snowstorm, it's winter, there's a fire going, you're dressed up in your wool sweaters, you're with people you love, and you're inside cozy. Sometimes it can be a thunderstorm in the middle of summer like it is today, and all you want to do is go outside, and you're kind of forced to be inside.
Fair enough.
That's
Okay.
mine.
What's my
I'm going to
question?
recycle a question that you'd asked before because I liked it. What is your death row meal? And why are you on death row?
Oh, I've led a pretty clean life. You just never know when death's going to come your way.
So what's your meal?
It would probably be a really good steak with peppercorn sauce, maybe a little Yorkshire pudding, maybe a big baked potato with all the toppings, and something green on the side.
Okay.
Yeah, I haven't thought about that much.
And then whatever green part is
Oh,
is the...
right. I'll make sure I eat the greens.
I think a lot of listeners are going to want to go get some steak and Yorkshire pudding.
What are we talking about?
Let's jump into it. Today we're talking about tax strategies. Again, this is a topic we had a number of questions on, and so I think people are going to want to listen up. Why don't you kick us off with our key tax strategies?
Okay, we'll go through them quickly, and again, then I'll go through into more details on each one. The first one would be, if you haven't already, open up a first home savings account and maximize your contribution. Number 2 would be maximize your RRSP contribution limit. Number 3 would be to maximize your TFSA contribution. Number 4 would be to try and avoid interest income in a taxable account. Because we talked about you're going to pay a lot of taxes if you have interest income. Dividends are preferred in a taxable account, but even those should be avoided if you don't need the income. If you don't need the income, why are you paying tax on the income? You're just paying tax, throwing away money. My preference has always been capital gains, A, because you don't have to pay tax on those if you defer them, and B, they're only taxed at 50%. Number 7, only pay taxes on realized gains. So that's sort of those two combined. And finally, if working with an advisor or a robo-advisor, absolutely make sure your investment management fees are tax deductible for your open accounts. So those are what we're going to cover. Let's go through number 1 first. What's that, George?
You said number 1 was to maximize your first home savings account contribution. And I think some listeners might right off the bat go, I know you recommended that as an account to start investing into, but what if that isn't one you're investing into?
If it isn't, skip it. If you're not planning on buying a house or you already have a house, don't need to do that one. There's no point doing it. No advantage. If you are thinking of buying a house or a condo down the road, definitely start with that one. It's got 2 advantages. It operates like a tax-free savings account, but it also is like an RRSP account because your contributions are tax deductible. You can put up to $40,000 plus the growth of that $40,000. And if you've got a partner that you're going into the house with or condo, there's 2 of them. So you could have 40 times 2, 80 plus the growth. You could have easily $150,000 that you could put towards the house. It's kind of like it goes from those accounts into the house. The RRSP goes from those accounts into the house, but then it's going to go back to the RRSP. You don't have to repay the first home savings account. That's why I love it so much. And I'm trying to look at stuff that gives you the biggest bang for the buck. There's only so many dollars you have for savings. This one is huge. So take advantage of it. Number 2, maximize your RRSP contribution. Again, biggest bang for the dollar. You put $10,000 in your RRSP, you're at that 40% marginal tax rate. You're going to get back $4,000 in your jeans. That's pretty good. You can then take that $4,000, you could go on a trip, you could put it into your tax-free savings account, you could pay down debt. You've now got $14,000 working for you. If you're in a higher tax bracket, you're in the 50% marginal rate, you could have $15,000 working for you on a $10,000 investment. That's huge. Take advantage of that. What's up next?
Next is maximizing your TFSA contribution limit.
Okay, so TFSA, whether you use it as an emergency fund or a backup fund or for a house down payment, you pay no tax on the growth. So you don't get a tax savings from it initially, but on any of the growth, you put in, let's say, $30,000 and it grows to $40,000, you won't have to pay tax on the $40,000. If you take the $40,000 out, you can put it back in the next year. So it's got all kinds of great little features that I love. TFSAs are great. And I've used them in a couple of cases where I've had older clients that wanted to give money to their kids or grandchildren. They take it out in December, give them the money tax-free, and then they put the money back in the new year. So they still have their TFSA going. So some great things there.
Now, again, if a listener or watcher is thinking right now, I don't have enough money to be saving to maximize all 3 of those accounts.
Follow the order. Saving for a house, first home savings account, then RSP, then TFSA.
Got it. And what if the amount you are able to save isn't even enough to maximize?
Start with first home savings. Even if you can put $3,000 in.
And what's the downside of it?
It's going towards the house. You can't use it for anything else. But sometimes it's good to have accounts that you can't use. It prevents you from, it's like a piggy bank. If a piggy bank's sitting there, you're going to dip into it. This is a locked piggy bank. You can't take money out of it unless it's going to a house. Yeah. Sometimes it's good to put some locks on things. Yeah. Some people need to put a lock on their fridge that it's only open between 6 and 7 at night or whatever. So this is just a lock on your money that's always there. Number 4, try and avoid interest income in a taxable account. If you've got those savings, put it into a tax-free savings account. Much better than just a savings account. We had one of our listeners who asked us about the $100,000 sitting in cash. At the very least, if it was in a tax-free savings account, they're paying no tax. If they're having to pay tax, let's go through the math. $100,000, today they would get 3%. That's $3,000 worth of income. If they got $100,000 in cash, they're probably in a high tax bracket. They might give up half of that $3,000 to taxes. Now they're left with $1,500, and inflation is 3%. They're losing another $3,000. So now they're losing money on their $100,000. So you don't want to pay tax on your taxable accounts. What's next?
Number 5, you say dividends are preferred in your taxable accounts, but even those should be avoided if you don't need them. In other words, you don't need the income.
So think about it. You could be working for a company, part of the stock purchase plan. Every time you make a contribution, they match it, or they may give 2-to-1 or 3-to-1, or maybe they just give you a discount on the stock.
Yep.
So they'll give you maybe a 15 or 20% discount when you buy it. But if it's kicking out a lot of dividend income to you, so maybe you work for one of the banks, it looks great because you're getting all this income, but you're having to pay tax on all that income. So it's not as beneficial as you might think. If you have a chance, if you can put that money into one of those registered accounts, TFSA, RRSP, First Home Savings, then you can get the best of both. You get the high income, but you're not paying the tax. For seniors, some of them love dividend income. Comes in regularly every quarter, they trust it. It's still taxable income, and I hate paying tax. I don't like avoiding tax, I hate paying tax. So it's our job to pay taxes in this country, but it's your job to make sure you're only paying what you absolutely have to pay.
Now, can you put this into layman's terms again? what we just said at number 5.
If you don't need the income, don't invest for dividend income unless it's in a taxable account.
Got it.
Okay?
I like that. Simplified, clean, crisp. Let's go into number 6. What's strategy number 6, Dad?
We touched on this previous podcast, capital gains. Invest for capital gains. You're only paying taxes on half of the gain. I really like it, and you can defer them. This is combining the two. The first one is you're only paying taxes on half of it. The second one is you can defer it. So you've got two advantages. Now, you can't always defer the gain. Sometimes you have to sell for some reason. But if you don't have to sell, you just keep defer. If you defer, you pay less tax.
If you do what?
Defer. Defer is a good word.
And if you missed our last episode, capital gains were covered in our last episode, so make sure to check that out. But let's move on to number 7. What is number 7?
Number 7 is if you are working with a financial advisor or even a robo-advisor and you have a taxable account, an open investment account, what we call a taxable account. If you pay management fees, you pay the advisor or the robo-advisor, and you do pay fees to robo-advisors, they're not free. They can't do all that advertising for free. Just remember, those fees should be tax deductible. If the fees are charged inside the mutual fund or the exchange traded fund, the fee's not tax deductible. It has to be charged outside to be deductible. So some big advantages there.
And what if people are thinking that what they're being taxed by using a robo-advisor is such a small amount that it's kind of trivial?
If you're in one of their portfolios, it's still expensive. Certainly a lot more expensive than if you were doing it on your own. You could be paying 50 to 70 basis points. It's cheaper than a financial advisor, but it's not for free. And you're not getting advice. The only advice you're getting is what's in the portfolio. They're not giving you tax advice. But make sure you're getting at least a deduction for the fees that you are paying in your non-registered accounts.
You should be aware of what fees are going into.
Yes, definitely. A couple of bonus ideas. We hear a lot about charitable contributions. They do a great job helping charities. They don't give you much of a tax benefit. Sorry, they just don't. They should give us more. You really get 15% of it. So you put in $10,000, you get $1,500, and then some complicated formula. It doesn't save you a whack of taxes. But if you're a charitable person, it's a great thing. It does give you some tax benefits. Invest in Canadian exchange-traded funds versus U.S. exchange-traded funds. Avoid U.S. withholding tax. So when investments, if you buy a U.S. ETF that is domiciled in the U.S., in other words, it's maybe from Vanguard, but it's a U.S. ETF, then there's going to be withholding taxes that you can't get back. So you're better to buy a Canadian ETF that invests in the U.S. And you can still buy them in U.S. dollars or Canadian dollars, but you're better to buy them from a Canadian mutual fund company or a U.S. mutual fund company that's working in Canada. So just, you need to be clear about that. Don't just go out and just throw your money at something and you might make a mistake there or pay too much in tax.
And so you said a U.S. mutual fund investing in Canada or a Canadian fund?
You're better to go with a Canadian domicile. It's got a base in Canada, a head office in Canada. Okay. Harvest capital losses. If you've got in a big year, let's say you like to buy stocks and you've got some winners and some losers. Those losers are typically in a capital loss position. If you've got a year where you've got capital gains that are taxable, sell some of the losers to get a loss and offset the gains. So, use an example. I've got one stock that I sold and I made a $10,000 profit. That's a $10,000 gain. And I've got another stock that I put $10,000 in and I lost it. You can offset those two and pay no tax. You just have to sell it by the end of the year. So when it says harvest your losses, if you've got some losses, trigger those losses.
Put them up against the
gains. And there's some fun stuff advisors will do if they're any good. They will harvest some losses in a bad tax year for you. They can move you from fund A to fund B and trigger a loss and still keep you in the same type of investment. That gets a little more complicated. And that's where advisors can help you. You could do it on your own, but often it's easy to mistake.
And I mean, we're giving advice here that applies to people who do use investors, some that are doing it on their own. So maybe that strategy is keep it in mind as a bit more of a advanced, complex one. So if you're doing this on your own.
It's level 2. We have some questions.
So I'll list up the questions like we've done before. First question, what is your favorite hack for avoiding taxes and getting the best return possible? Are you talking about big donations, RRSP contributions, or something else I haven't heard of?
Okay. If you look at the first 8 and you're taking advantage of all those, you're doing an amazing job. Don't keep looking for some more complicated stuff. If it's more complicated, limited partnerships, oil and gas partnerships, whatever those are, run away. You're lucky if you just get your money back. It gets back to the complicated versus uncomplicated. If you don't understand it, don't invest in it. Don't invest in a strategy just to save taxes. Invest in an investment that is still a good investment that helps you pay less tax. A lot of advisors, especially in the olden days, used to sell investments, film partnerships, all kinds of crud like that to save on your tax bill, but you ended up losing half the money anyway, so it wasn't worth it.
Yeah.
And it made your tax return so complicated. Often what would happen, you'd get audited 5 years later that you owed a whack of taxes from an investment that you don't even remember making. Just stick to the simple stuff. It's the best advice I can give you.
It aligns with what we've talked about before. There's no kind of hack to the system or way to cheat. Continue on with these tried and true strategies.
There's enough meat on that bone. If you just go after those, that'll reduce your tax bill.
Awesome. Let's jump to the next question. Make dealing with the government less daunting. It's not something we're taught much about, so it's generally not fun at all.
So my advice there is tax returns are really complicated. Do your own tax return. Use one of those apps. Do your first tax return, maybe your second. After that, get someone else to do it, unless you really like doing that sort of thing. If you're good at math and you love that sort of stuff, do it. It's enough work just getting all the tax receipts together without having to put them all into a thing. Like, you're going to spend a couple of nights doing it. It's not worth it. Someone will do it for you for less than $100. It's worth it.
Make sure they're qualified.
Make sure they're qualified, but don't go fly by night, or then you won't get the tax refund. Number 2 is set up your Revenue Canada account. At least log in. It's not easy. It takes a few weeks to get allowed back into your account, but once you're in, it's worth it. And then you can figure out your TFSA room, your RRSP room, how much tax you paid, all that stuff.
Next question. What's your advice when it comes to taxes? I'm not asking for tax evasion, but there are still very common and practical ways that people in our generation can reduce their taxable income beyond maxing out their TFSA or RRSP. For example, I drive to work every day, and my recent accountant advised that I can claim some of those expenses on my tax return, which was brilliant and legitimate. What are some other things that I might be missing out on? And I think a lot of our viewers and listeners are going to have these questions because we hear from our friends these things like, oh, you're not taxing your work from home setup. Oh, you're not taxing your drive to the office or your master's degree or your additional education courses. And so I think a lot of people feel like there are these little hacks that they're unaware of.
So first off, if you're just driving to work and you're not having to drive anywhere else during the day, that's not a tax-deductible expense. Sorry, your accountant's not correct on that. If you're driving to work and then you're driving to a client's and then you're going to another client's, then you can deduct those expenses. You need a T-2200 from your employer, which is a tax document. They'll sign it and they say as part of this job, they need to have a car. And then you can deduct some of the expenses related to traveling around, the car expense, the gas, but only for the portion that is relative to work. But if you're just driving to work, that's not deductible, nor is taking the subway to work. That's not tax deductible. If you're working from home, yes, you can definitely some expenses. You can deduct a percentage of your apartment or your condo or your house. So if it makes up 15% of your house, the square footage, you can deduct that. You can deduct supplies, your internet, all kinds of things, but you need to be working from home or being self-employed. Those are the 2 key variables there. So it's not going to apply to everyone, but for those who are working at home, there are some things you can deduct.
I think a lot of people are working from home these days, at least for a portion of the time. So where should they go to find out these hacks?
To be honest today, you just chat. Just go into chat and say, I'm living in Ontario, paying tax, here's my income, I'm working from home 3 days a week. What are the top 10 things I can save on?
That's great advice. And let's remember that while ChatGPT has great input, you need to be fact checking and constantly pressure checking the advice you're given from chat. As someone who is completing a master's degree during the time of ChatGPT, it becomes clear really quick that sometimes ChatGPT can give you advice that seems very legitimate, and then you start to question it and ask it where it found that from. Please send me a credible source where this is written. And more times than you'd like it to, it says it can't find where that information is found from. So use ChatGPT to your advantage, use it smartly, and continue to make sure it's giving you information from qualified, credible sources.
When you've got a lot of deductions, go get someone to do your taxes. And if you get the right person, they're not going to charge you a lot, and they're going to save you a bunch of money in taxes, a lot more than you pay them to get the return done. That's where a professional comes in. That's what they do for a living. And they're up to date on all the tax changes. Whereas chat is behind. And depending if you're paying for the free version or the paid version, you're still behind, and the rules always change.
Next question. Is it better to enroll in the RRSP pension plan through work or employee share ownership program?
Here's the simple thing. If you're going to get free money, take advantage of it from your company. It's still taxable to you, but it's free. So you're getting the after-tax benefit of it. I prefer the RSP pension plan because the stock purchase plan is great, but it's in a taxable account. Whereas the pension plan and the RSP, group RSP plan is a non-taxable account.
Right.
So always go for the non-taxable versus the taxable. That's the simple rule.
The employee share ownership program is
a taxable account. Giving you shares that are taxable.
But the RRSP
pension plan is in a tax-free account.
Awesome.
What's your takeaway, George?
My takeaway here is that one, there's no way to cheat the system, and
people do cheat, but we're not talking about. That's not what this podcast is about. I don't want to think that someone's after me, and eventually they'll catch up to you. Especially with AI, the government has AI now. They're using it, and it's going to help collect a lot more tax cheaters than they have in the past. It's why they've been able to reduce the number of people. They've just cut a whole bunch of people who used to do follow-up on income tax, and now they've got AI doing it.
So the two main takeaways from today's episode: one, take advantage of tax-deductible accounts first. And second is use as many of these tax strategies as possible.
It's free money. You don't need to leave the money with the government. If it's rightly yours, get it. That brings us to the end of another week. That covers the tax series. Next week, we go to love and money. It's going to be a lot of fun.
Romance.
Romance.
Thanks, everyone. We will see you next week.